Welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, and it is July 24th, 2024. It's a Wednesday that we're taping on, and man, what a day we saw today. Joining me again, we've missed you, Arusha. Hope you had good travels in Sri Lanka. Arusha Paris, of course, who usually joins me every week. He is a portfolio manager and research analyst over at O'Neill Global Advisors. How you doing, Arusha?
I'm doing well, but maybe I should go back to Sri Lanka with the market being really this bad.
Yeah, exactly. You know, it's go back into the hole, right? Yeah. Kind of like the groundhog.
Yeah,
so, and then of course, helping us make sense of today and what's going on in the market is Mark Minervini. We're welcoming him back to the show. Mark, of course, is a two-time U.S. investing champion. We just had David Ryan on last week. So Mark and David actually used to do a lot of workshops together. Mark is also the founder of the Minervini Private Access. He's got some great books out. Gosh, I mean, the Think Like a Champion. There's just, how many books do you have now, Mark?
I think 4.
4. Okay. They're just not just about trading, but kind of the mentality of winning, which is great. So Mark, it's great to have you back on the show.
It's great to be here.
Yeah. So let's get right into it. I mean, we're going to talk a little bit about the rotation, whether or not this time it's for real. And there's also a lot about the relative strength lines. There's a lot to cover, but let's start with a look at the market. And we'll start. What do you want to start with? The NASDAQ or S&P 500?
Well, I think, if you take a look at today's action, you can see we had a big sell-off. This was something that, we talked about the other day when we were having a rehearsal for this.
Yeah, if only we had that pre-show.
Would have been a good.
Yeah, it would have helped people out quite a bit because you were pretty negative on the NASDAQ and the Mag 7, really.
Yeah, in the near term, the FANG stocks, the Mag 7 stocks, the NASDAQ, because they're so heavily weighted in the S&P 500 as well at this point. So you have a big sell-off today. 5 days ago, you had distribution day. 10 days ago, you had a big sell-off. So you can see those big down days, then you get some dead cat bounces, and then you get another big down day. And that's just, consistent with a market that's correcting. But I think if we take a look at do we have a Russell 2000 where we can compare it to the NASDAQ? We take a look at the NASDAQ compared to the Russell 2000, you'll see where there's really a rotation taking place here, where you're having money seems to be leaving the mega caps, but going into the small caps. And to me, that makes a lot of sense because the small caps have underperformed for an extended period of time. You've had analysts bullish on them for the last decade. There's been a number of false starts, and I thought for a few times, we were going to get going in the Russell, but it didn't materialize. So we had to quickly shift away from the small caps. And this may be the time where, we're really getting a true sustainable shift. I think the jury's still out and it's still early, but so far so good. But if you look at the two charts, you'll see going in the complete opposite direction over the last couple of weeks.
Yeah. Yeah, it's very dramatic. And really, it seemed like July 11th was a little bit of an inflection point when that CPI report came out. And, things were coming in a little bit in terms of inflation, getting a little bit better. It was the NASDAQ down and the S&P 500 not down as much. Russell 2000 up 3.5% on that day when the NASDAQ was turning.
So there's been a number of inflation reports, we haven't gotten the reaction the dramatic reaction like we just got, and the probabilities of a cut this year and a cut being a 0.5%, a 0.5 point cut versus a 1/4 point or no cut has increased dramatically. We've seen that a number of times though, where the probability, everybody watches Fed Watch and these sites and so forth, the probability went up and then it never happened, and then the probability for the next month went up and it never happened. This time it's looking more like we may get a cut. I still think the Fed has to be very cautious, and you'll get maybe a 1/4 point, maybe a 0.5 point. But again, with housing strong, the market strong, very low supply in housing, you have the potential to create a bubble in the stock market and in the housing market. And those are the two places that people feel the wealth effect. They feel wealthier when their house is worth more, their stock portfolio, their retirement fund accounts are up. They feel more wealthy, and that helps inflation. So there is some risk there of bringing rates down too much too fast. So I think it's going to still be moderate. But the other thing I want to say is that, you know, people waiting for rate cuts, the market has discounted the rate cuts. This is old news, and the market has gone a long way. So there's been a lot baked into the cake at this point.
Mm-hmm. So Mark, with this environment and the Nasdaq breaking the 50-day and the S&P starting to break it too, what should investors do at this point, or how should growth investors be handling this type of environment?
So I tend to never be guided by the indexes. Like, I'm not selling my stocks because the S&P 500 is breaking the 50-day or the 200-day or any moving average or any index. I'm selling the stocks based on their individual action, each individual name. So we've already been taking profits in the names that were extended and vulnerable, that we had nice profits on, and we've already been stopped out of a lot of the names that have already rolled over because leading stocks lead. And this is something I want to talk about in just a second here about the Russell, how to handle maybe moving into small cap and start entertaining small and mid cap names. You need to do it before it's evident and it's so obvious in the indexes. So the individual stocks are what guide me. And you know, when you go into a particular trade, you should have your stop loss, and when those stops start getting hit one by one, I'm raising cash. And so the question is, well, what do you do with that cash? Are you rolling it into new names? Well, that's where you know whether you're in a correction that maybe is a little more severe. If you're in some pullback, you're probably going to have some names that break down and hit your stops, but you'll have other names that are setting up, and you'll see names working, and you can rotate that money. But when the opposite happens and you're getting stopped out and you don't see many names setting up, or the names that are setting up aren't working, and then that's a different story. And that's, I think, where we are now. Now we're in more of a correction, but this could still be a stealth correction. And when I say a stealth correction, I shouldn't say a stealth correction, a rotational correction, where one area of the market corrects, but another area firms up. And that's where you got to let the stocks guide you and start looking at those small cap and mid cap names now that are setting up, because by the time it gets obvious in the indexes, the leading stocks are already going to be taken off. They're out of their bases, and then you're chasing up late stage bases.
Yeah. And, to that end, you mentioned how, okay, the $1 trillion club, right? Your Alphabet, Tesla, Microsoft, those names have definitely come in, but it's kind of interesting to see the difference between the S&P 500 and, let's say, the RSP, which is the equal weighted S&P 500. So it's a pretty big difference. Whereas the S&P 500 has come in a lot sharper. The RSP was breaking out, when the S&P 500 was kind of coming in, and it's RSP has come in a little bit too, but it's not at its 50-day moving average line yet. It's
to a certain extent the QQQE also, which is the equally weighted Nasdaq 100. That broke out of a big base recently, and to me that's a good sign that you've got broadening. So if the heavy weighted index is correcting and the broader base index, as you're making that case where the equally weighted is holding up better or breaking out, that tells you that the participation is broadening. See, for a long time, we had very narrow participation. This market has gone up on just a few names because we are at almost unprecedented times. 2000 was even more concentrated, but not by much. Right now, 5 stocks in the S&P account for 20-25% of the S&P. 20-25 names account for 40%, give or take. You've just got this gigantic concentration where all this money is chasing. We talked about this the other day, where there's this monopoly now, or triopoly, or whatever you want to call it, that haven't seen this type of environment since going all the way back to the Rockefellers and Vanderbilts, and where you've got this monopoly. And as I pointed out before, the reason why is, number one, you've got these big companies that have so much cash, they buy up everybody, they crush all the competition. But even if antitrust and things like that that's probably nowhere in sight on a broad-based scale, because Congress, these elderly men that don't really understand technology. We talked about how Zuckerberg went and testified in Congress, and they said, "How does Facebook make money?" And he just looked at him and said, "Advertising." They don't really understand. It's the Wild West,
Well, it's a big difference between in the 20s and 1920s, where when it was Rockefeller and Standard Oil, everyone could understand that, right? Versus now, if you're not tech savvy, if you're not tech savvy, it's much harder. Like a lot of the people in Congress, much harder to understand what these tech companies are doing and why some of these kind of acquisitions and all this kind of stuff could be more monopolistic than anything else.
Most people didn't even understand what AWS was until the last few years of what was actually driving Amazon. So Amazon's the greatest disruptor of all time. They're going into drugs now, where CVS, Walgreens, you could say goodbye to that drug model, that drugstore model, because now you're going to get them delivered to your home, probably much cheaper, much more efficiently. They started with disrupting the book industry, and then disrupted everything. At one time we had the Sears catalog. We'd go in there and order something and get delivered to you. It's a whole different world now, and it's the Wild West. And these companies got the run of the joint. I mean, they really do. Google, Amazon, Apple, they're ruling the world right now. And but here's what you have to remember: stocks are a discounting mechanism, and as much as they're dominant and they've got these big earnings, they're trading at huge multiples, and it's been a long time that this has been going on. So they're priced for perfection, and at some point, regardless of how good the business is, I heard this argument. I've been doing this for 41 years. Every bull market, I hear it's different this time. These companies are great. They're never going to go down. That's not true. They will go down, and they will go down big, and some of them will do things that you can't even imagine can happen to a big company, like something like an NVIDIA. So it's just a matter of time. But there's thousands of other companies out there, and hundreds and hundreds and hundreds of companies growing at 25, 30, 40% a year that are ripe to be invested in, because they're underfollowed and they're smaller and they're mid cap.
Well, Mark, we'll just very quickly. I remember I want to say it was end of 2021. You made a bet on Twitter with someone that Amazon would the person thought that Amazon would never drop more than 30% or something like that.
Yeah, I think 35% in 2 years. He said no way, but he never
closed that account.
He never closed the account. He never paid up on the bet.
Well, it's just that easy, That's a good way to duck a bet.
I think it was only like 6 months later he got the 35% decline. But yeah, look, these stocks have gone through big declines. Amazon at one time, I bought Amazon in 1997 off the first base that it formed. I think it was 97. Yahoo was in 97, right off the 1990s, the late 90s. I bought off the first IPO base, bought Microsoft off the first IPO base, Cisco System off the first IPO base. All these companies that are household names that back then very few people even heard of, and none of my institutional clients would even consider buying. Yahoo was trading at 908 times earnings when I pitched it to institutions, and they said, "What are you, crazy?" And then the stock went up 8,000%. But many of these stocks went down 50, 60, 70, 90%, my 50-80 rule. So the 50-80 rule will definitely not only grab a hold of these big names, but at some point, not only do you get the 50-80, which is 50% of leaders go down 80%, 80% go down 50%. Once they top, once you get a secular top, the average decline is about 70%. That's history. That's just facts. It'll happen over and over. But that's not the worst part. The worst part is many of these names, Microsoft stayed down for 20 years. Right. Cisco, 20 years. GE, which we just bought GE just recently. It had a nice day yesterday. Exploded to the upside. Today pulled back, I think, a little excessively. I would like to see it hold up a little bit better. But these companies, many of them aren't even back to their old highs from 2000. So if you were buying up at that, up those highs, like you might be buying NVIDIA now, 20 years later, you haven't even broken even. So that's the real risk, is that time value as well.
And on the one side, you still have a lot of people talking about, oh, AI, we're in the early phases, and this is going to change things like the internet did in the 90s. So, but right now, I guess, there's still that question mark of monetization. And to your point, Cisco remained a powerhouse for the internet in terms of its networking. Everyone kind of had Cisco stuff, but the stock wasn't getting back to its highs, even though it remained a very important company. So how do you kind of know which ones are the survivors, I guess?
You don't. I mean, if they're delivering earnings and the stock is staying in an uptrend and it's behaving, you stick with it. But, all these stocks that go up, 50, 100,000%, how many people actually hold for that entire move and hold through the pullbacks? Almost nobody. Maybe someone here and there on rare occasion, you hear these stories. But I always say, somebody wins lotto every week too. But every week the name is different. So, but the bottom line is that, these companies, like in 2000, where everybody said everything's different this time, the .coms were the AI, sort of the AI craze. AI, I'm bullish on AI. I think it's awesome. We're actually programming AI. We have a Minervini AI right now that we're releasing soon. That's pretty cool. It's a pretty cool tool to help people with technical analysis. But I think AI has been it's so hot that before even OpenAI, before these companies even come public, they're already overvalued or fully valued. Maybe they get a pop. I don't know, but I think the runway for AI, as far as an investment, I think it's been shortened by such an exuberance for it that the valuation is, you're able to, the market is a business, and if there's an appetite, they can mark things up, just like you can sell a Louis Vuitton bag or Hermes bag for much more than you could sell a Coach bag for. So because that appetite's there, the demand's there. It's the same thing with this. So I think that it's taking some of the runway away from this great technology, but a lot's baked into the cake, I think, even before it's even come out to a certain extent.
Yeah.
We're
going to take a break.
AI. I don't want people to think I'm bearish on AI. It's
no,
awesome.
no. Yeah.
Well,
I think you made it clear.
I just don't think it's as big as people think as an investment. I think it's going to be tougher to invest in.
Well, and as you said, it's more of the runway that's left. How much more can some of these companies go without a little bit of a larger correction, kind of like what we saw after the .com. I mean, that wasn't the end of the internet. It was still just the beginning, but you did have
90% of the companies went under.
Right.
I don't know if there was a company called Dr. Coop. I don't know if you remember. It was one of the first ones to go bankrupt. That I remember I was on CNN and I said most of these companies are going to go the way of Dr. Coop, and they did. It was a consolidation. Look, at one time, if you go back into the early 1900s, there was 300 plus automobile companies.
Yeah,
300 car companies plus 300 car companies, and that boiled down to 3. Even back when I was investing, just starting to invest in the internet, and nobody even understood what it was. 1998 or 99, I think it was, maybe 98. I was on with Ron and Sana on CNBC, and he said, "Do you think the internet's going to survive?" And this is like going around 2000. I mean, you can't even imagine thinking that now. Does anybody think this internet thing's not going to survive? But that's how it was. And I remember I said to him, not only is it going to survive, we're at 2 tin cans in a string right now. Like, there's still so much more to go.
Right.
But again, how much is baked into the cake? And what are they selling you? They're selling you all these .com companies. Well, all someone had to do was put .com after their name, and everybody bought the stock, and there was nothing there. Well, now that's kind of like AI. Yeah, that's probably if you just tell people we have AI models, they're going to be interested in buying. Buying stock.
And for a while there, we were seeing in earnings reports, it was almost like, oh, count how many times they say AI, and that's what kind of drove the stock on the earnings report more so than the earnings. But then no one was showing like, well, wait, how are you making money on AI? That's kind of the trick there. So
AI is still expensive to utilize. It's not, the price hasn't come down. That's one of the reasons why we haven't released ours yet, because the pricing we're working on it right now to work it in a way where we can make it somewhat, affordable for us to be able to deliver it to the customers. But as the price comes down, it will explode, and everybody will be using AI in some way, shape, or form. So yeah, I mean, I'm super bullish on AI. Just the thing I think you have to realize too. I have a rule: never buy the story, never buy the numbers without confirmation from the price. Right. So, and this is an O'Neill rule. O'Neill used to say, if the company's so great, if everything's so wonderful, why is the stock going down? Why is it a 14 relative strength and it's hitting a 52-week low if everything's so rosy? So that's great, but make sure that you're not going in there saying, oh, this technology is great, and you're buying it all the way down and sinking a lot of money into a stock that's not performing, because you could get caught holding the bag, with just pumping a name with the .ai behind it.
Mm-hmm. Well, to that end, we're going to take a break. And when we come back, maybe we get into that idea of relative strength a little bit more and how important that can be for choosing your stocks. Stay tuned. We'll be right back. We're back on the Investing with IBD podcast. It's Justin Nielsen. And of course, Arusha Peiris is joining me this week. He's back from Sri Lanka. And we also have Mark Minervini, two-time U.S. investing champion, founder of the Minervini Private Access, and author of numerous books on investing and the championship mindset. Let's get into a little bit of this idea of relative strength. And you mentioned the Russell 2000 to kind of start. And it's interesting that, there's two elements here that we have to discuss to make sure that everyone kind of understands what we're talking about. Number one, the relative strength line, which is comparing a particular instrument versus the S&P 500. Of course, in Market Surge, you can set that to other things, but the default is the S&P 500. And then there is the RS rating, which let's go ahead and pull up IWM. That'll give us a rating. IWM, you see a relative strength rating of 77, meaning that compares it to all the other companies and instruments, ETFs, everything in our database. So, Mark, when you're using relative strength, how are you using this to kind of gauge where you're going to be moving your money?
I tend to put most of my trades that I take are in names that are in the 90s in the relative strength, just by default. Not all of them. Occasionally, I go below. I used to have basically a cutoff of 89, and then below 89, I really require the fundamentals to be stronger. I need to know more about the situation, and I just get a bit more careful the more I go down in relative strength. And the next tranche down would be to get down below 80, you get into the 70s, and below 70, I pretty much want to stay away. So the 70 would be the cutoff, but 90% of my trading is done in names that are 89, 90, and above. That's just simply from a qualifier, just to qualify names, narrow the market down to a shorter list, and be in the better names, the names that are performing. So just real quick, tell you, how I got to using, I'm really a bottoms up approach where the stocks really guide everything I do. 90% of what I do with trading is guided by how the individual stocks are acting. But it didn't start that way. When I first started, I was a quant, which means that I would form a macro opinion and an opinion of the market. And then once I got a bullish opinion of the market, I would start looking at groups. And then from there, I'd look for the best groups, and then I would look for the best stocks in those groups. So what happened was, by the time I formed that market opinion and I got to those groups, I would look and I'd see all these stocks that earlier were set up perfect to my criteria, but now they were up way above the buy points. And I said, why did I miss that? The reason I missed it was because I was doing things backwards. The leading stocks lead, and the stocks will bottom ahead of the market. The better stocks will bottom first. So while the market's, even sometimes in a bear market, it's making new lows, you've got the leading stocks are making higher lows, and they're turning already into uptrends. So what I did was I flipped the whole thing around. I said, okay, you know what I'm going to do? I'm going to go stock first. That's going to lead me to the groups. And when I'm finding stocks and I'm finding groups, well, that means the market's pretty good. and everything changed. That went from the 1980s. My first trade I made was in 1983, Alice Chalmer. That was my first stock I bought. I did very poorly for 5 or 6 years. I did okay in 1989. Then 1990 bear market, I started having an idea of what to do. And that's where I caught Amgen and US Surgical and Microsoft and all these names that at the time were small mid-cap names that not too many people knew. And I started doing well. And then in the mid 90s, that's where, I did really well. And market wizards, Jack Schwager got a hold of my performance. And that's where people have read about. I started to know what I was doing at that point. But what got me to that point of doing really well was flipping that whole process upside down or backwards and and that's what I do to this day. So relative strength is like the first cutoff. If the relative strength's not there, if the stock's not performing, this goes right back to the rule I said before. Never trust the numbers, never trust the story unless it's confirmed by the price. So the first confirmer, if you will, is the RS. If it doesn't have the RS, it doesn't matter to me what the numbers are. It can have 500% earnings this quarter and sales, and everything looks great fundamentally. But if it doesn't have that relative strength, then I'm not going even to be interested in it. And then from there, it has to be in an uptrend. If it's not in an uptrend, this is in my book, the criteria for what I call a stage 2 uptrend. This isn't my invention. This goes back to Wyckoff and my good friend Stan Weinstein, who basically wrote the book on this stage analysis. I met Stan in 1990, and he basically changed my trading at that point. I didn't have that rule, and I met him in New York City. We had lunch, and to this day, Stan and I are great friends. We talk all the time, and those are the qualifiers. So it's got to be in an uptrend, got to have that relative strength, or I'm not even interested in looking at the stock.
Mm-hmm. So Mark, with the relative strength rating, especially, so say you're looking at the Russell 2000 and trying to find a small cap name that could be going, a lot of times, especially those who are new, they'll wonder, the RS rating's already a 99. Haven't I missed it at this point? Mm-hmm. Generally, what do you say to people when they ask that type of question?
So it's a little tricky, because that's true that a 99 could be indicative of a stock that's made a big move, and you can top at 99. You top usually, at the strongest, you're gonna at some point reach the peak. That's where there's other parts of the analysis that come in, but this is relative. This is a relative rating. So you can have a stock that goes sideways while the market goes down, and the relative strength will improve, right? Mm-hmm. So, and that could ratchet up to a 99 just by not going down very much, or even going down less than the market. Let's just say the market goes down, the Dow goes down 35%, and the stock goes down 5%. That's going to really pick up a lot of RS. So here's my general rule of thumb. When the market's in a bear market, when we're in a bear market, I want to go for high 90s. I want all high 90s, 99, 98, 97, all the high 90s, because during that bear market, you're not getting stocks that are making big moves. They're picking up relative strength because they're resisting the downtrend, and it's like a spring being loaded. Now, when you get into a bull market where you've been going for years, and now you have a stock that's a 99. Let's just say NVIDIA or some one high flyer. It's been going for a long time. Now you're on your fourth stage base. Now you have to start. It doesn't mean you don't buy it coming out of a base if it's a 99, but this is where cutting your loss is even more important, because now you get to the 50-80 rule, where once that big leader tops and you get a secular top, it's going down most likely 50 to 80%. So that's everything in the market is. Context is everything. It's really important to put things into context. But regardless of where we are in the cycle, I'm never lowering and saying, "Oh, we're late stage in a bull market. I'm going to go with 70 relative strength and avoid 99s." Never. Mm-hmm. I live and die by the RS sword. I live and die by the stop loss. I made a decision a long time ago. I'm going to traffic in the best names. This is what Livermore did. And it's the same. This is what O'Neill did, David Ryan, myself. I'm going to trade the best names. And if the best names can't do well, then how good could the market be? And the other thing, I made a decision. This was in the in the late 80s after I got chopped up holding some stocks. I said, I'm drawing a line in the sand. I'm never ever allowing a stock to go down and create a big loss for me unless it gaps through my stop, and then I'm just taking the next best price. But they're gonna have to beat me one stop at a time and nick me to death. And I've never ever broken that rule in 30 some odd years, and the rest is history. That's when all my great performance happened.
Right. Now, I want to just kind of go back to the relative strength idea because, yes, there are those companies where they're very high relative strength, and you have to look at the chart to determine are they extended and everything. But what about on the other side, especially because you've been talking about these rotation plays potentially? Do you get a situation where if there's a rotation, you might have stocks that haven't been participating, and so the relative strength might be a little bit poor on those? How do you kind of decide on on a rotation play where to go?
Look, hindsight is 2020. Of course, you can go and look back and say, well, the stock bottomed when it was a 2 relative strength. That's true, but like I said, somebody wins lotto every week, but every week the name is different. Trading stocks, you have to develop a method that is something that you can duplicate, and you can have some reliability, and not where it's a shot in the dark like throwing a dart and it's going to happen once in a while. Can you identify that and consistently have a strategy that produces X amount of gain, so you mathematically can manage your risk in relation to that? I haven't found a way to pick bottoms and tops. So the bottom line is you have to give up. If you're a trend follower, you have to give up picking the low to make sure that the stock is in an uptrend. But what I have found is that it's unnecessary to pick bottoms and tops. And that's what's really important. I just said to myself, what is necessary? What do I have to do to get to my goal? My goal is to make big returns with very little risk and do it consistently and build wealth. And my thinking was, what is necessary to do that and what's unnecessary? So I threw out all the unnecessary stuff. Then it came back to just looking at the O'Neill studies, the Love studies, going back. We did our own studies. I did big, long studies of the biggest winning stocks. What we found is that the biggest winning stocks, before they make their big move, are already up 350% on average. So again, the data bears out that you don't need to pick lows. Also, think about this. Let's just say you could get the exact dead low. Let's just say you're in a stock gets pummeled, it's down 50%, right? You buy the exact low. Okay, so now that stock goes all the way back up to its old high, which means that it has to go up 100%, right? Tops at 20, goes down to 10. You buy it right at the low, it goes back up to 20. You've made 100%. Well, if that's going to be the next Amazon and go up 80,000%, what has to happen? It has to make new highs all the way in an uptrend. That's right. So you're not. There's nothing. Buying the low is irrelevant if you're going for that big move. So everybody's so infatuated with buying stocks that are down, but it's just simply unnecessary. And if you're making a big move in the stock, that low is only the tip of the iceberg. Even if you bought, and nobody's going to buy the dead low with precision and accuracy and consistency. But even if you could, a recovery back to the old highs, even if the stock is down 60, 70%, is only a couple 100%. And the data says that the average big winner goes up 350% before it even becomes a big winner. So again,
and if you say you buy the actual low, they never really go straight up right back to the highs. They're gonna chop you out for another 6 months or so and wear you down, and then you're getting out right when it's ready.
Years.
Years. Yeah,
you can buy the exact low. This is something that I learned from Ed Sakota. Buy where momentum is strongest, because time value. Okay, so you buy it at the dead low at $20, and it goes sideways and goes up to 25 and back down to 22, and you hit the dead low. It never stops out, but takes 5 years to make a move. Meanwhile, I bought stocks at all-time highs and trading at 500 multiple, and in 4 days, I'm up 40%.
Yeah.
And I consistently, this isn't something just once in a while, consistently buying stocks that are up in just a number of days or weeks or months are up 10, 20, 30, 40, 50%, sometimes even more, 100% in days, weeks, or months versus waiting this long period. Now, I can compound that money. I can turn it over. So that was sort of the next thing I looked at. Now, see, when I first started trading many moons ago, I'm going to be 60 years old coming up in January. So I've been doing this for 41 years. And when I first started, you couldn't short-term trade. There was, first of all, the commissions were $170, $190.
Oh yeah, they'd kill you.
$250 a trade. There are hundreds of dollars per trade. You had spreads on the NASDAQ names. The NASDAQ was just like crap. It was like the OTC names. That was really the secondary market, and spreads would be sometimes $6. A stock would be $3 to $6. You buy a stock, it was nothing for a stock to be 13 bid, 16 offered. Right. So just think about that, and I made money in those periods, and you had to pick up the phone, call a broker. He called the floor. They called back. Sometimes you would buy a stock. You wouldn't know you owned it for 30 minutes. Meanwhile, the thing's going all over the place. It's moving against you. You don't even know if you own it yet. So, right. You'd wait for that call back. And then when in really fast markets, especially in like the crash of '87 and big bear markets, the market makers would not answer their phones. They'd just ring and ring and ring. And you couldn't even get out. This is what we dealt with, and how to figure out how to make money. So then online trading came and spreads narrowed. And you had you could just click a button. All that changed, and that created where you could trade faster and you could take advantage of shorter term movements. So then I started looking at opportunity cost and said, okay, well, if I could grab 20% in 1 month on a stock, well, if I can do that over and over, I don't have to do that too many times to get to that 100%, as opposed to trying to find stocks that go up 100%. So that's what got me to be more of a swing trader. And that's where swing trading didn't even exist. That by default just developed. It started with what was called the So's Bandits. They would go in and they would grab the odd lots, the 100 to 200 shares, and trade them very quickly and day trade. And this led to swing trading and shorter term trading. And now you got people who, I've got friends that are day traders that make 2,000 trades in a day, just scalping back and forth for pennies. So it's there's a number of things that you have to look at in terms of what's necessary to get to your goal, as opposed to what you feel intuitively might be the right thing to do. Very often, it counterintuitive is what works.
I also wanted to kind of when you talk about relative strength and kind of when you're in a market environment for growth. You mentioned how a lot of times you look at the IBD 50, and that can kind of give you a sense of, okay, is this an environment where growth is in favor? And on Market Surge, you can just put in the 0 IBD 5 just to kind of let people know this is different from FFTY, which is run by Innovator, because this 0 IBD 5 is a price weighted index. So that does mean kind of like what we've seen lately, where some of these, the Mag 7, some of the higher price stocks, we're getting into a larger weight in this index. So talk a little bit about what you're seeing with the IBD 50 index right now and how that's kind of gauging things for you.
So a couple of things about the IBD 50. First of all, recently it's sort of broken down. Its relative strength is broken down pretty dramatically. I can't see the chart fully on the screen right now, but I don't see the right side, but I know the right side of it. The relative strength has really rolled over. So, but if you take a look also, it is price weighted. And I wouldn't look at the FFTY. I don't think it does a good job of representing the IBD 50. But the IBD 50 I think is a pretty good representation of if you're trading those type of names that I would traffic in, the higher RS names, the big earnings names. The IBD 50 does a pretty good job. Like when that's not doing well, I'm usually not finding a whole lot of ideas. It's a pretty good barometer or gauge of market health as far as that's concerned. And even though it's price weighted, you could see it. You compare it to the NASDAQ, you compare it to of the S&P, it was underperforming while those indexes were doing well. So it's not really weighted that heavily to the mag stocks.
Right.
It's still, it's still true to, I think, more of a Can Slim O'Neill type method. But now, again, you look at these indexes and you can see where we have had this particular market right now is, I've never seen such a bifurcated, trifurcated, whatever you want to call it, in every different direction. There's just such a dislocation with the indexes. Look at the Dow. Okay, now you've got the NASDAQ rolled over, but the Dow exploded the last couple of weeks to the upside,
right,
along with Berkshire. If you look at BRK.B, look at Berkshire Hathaway also exploded. So you can see not only did money come out of the Mag 7 and go into the small caps and the mid caps, it also went into value. It went into value and industrials. So that's a defensive move too. So that's not the greatest sign for a bull market. It's showing that there might be some aging there, but certainly money is rotating. You got to remember, money has to find a home. So money never sleeps, as Gordon Gekko said. It moves around, it finds a home. Your job as a trader, as an investor, is to follow the money and follow where those flows are going, and learn how to identify significant money flow of where money is sustainably moving from the big boys. And your job is to be a caboose if you're an individual trader.
Right. And, just in terms of the macro side of this, and I know that you're, again, looking at the stocks more, but for instance, on the home builders, you kind of mentioned how those are looking strong. And one of the ways you find that is, well, gosh, a lot of home builders were setting up, right? KBH, Multi-Home, Toll Brothers, you go down the list and you see these all setting up, and it's like, oh, something is going on here. So is that also kind of telling you about that interest rate side? Because, there have been the insurance plays, the yield curve getting less inverted, has helped the banks, whether it's KRE with the regionals or KBE, which is a little bit more spread out. There's been some power in some of these areas that have been a little bit more rate sensitive.
Right. And I don't want that smoothing effect where I own the group. I want the best stocks in the group. And usually in any group, you've got some groups like the oil group or the semiconductors. Those are big groups. There's lots of names, hundreds of names. It's hard to pin down just a few names. But in most groups, you can narrow it down to 2, 3, 4 stocks that are the key leaders in those groups. Even just branding wise, you think branding, if I said to you, hamburgers, what would you say? Probably McDonald's. Right away. Boom. If I said to you home improvement, you're going to know Home Depot, Lowe's. If I said to you colas, what are you going to say?
Coke.
Coca-Cola. What's number 2? We're going to say
Pepsi.
What's number 3?
Dr. Pepper Snapple, right?
Yeah. What's number 4?
RC Cola.
See how it gets harder?
Right.
So as you go away from 1, 2, and 3, it becomes exponentially harder to pinpoint a leader in any industry. It's just, that's just the way it is. They call it in marketing the law of duality, or where it really comes down to just a couple companies. So that's what you always have to think about when you're investing with stocks, is that you're looking for the best merchandise. You're looking for those really, really great companies, especially if you're going for the bigger move. If you're going for the bigger move, this is really important. Earnings, sales, leadership position, scalable business models. This is important stuff. If you're trading very short term, well, then it's more of a technical nature. Your trading is going to be more of a technical nature, because you're not going to be sitting through earnings reports. You're grabbing stock price moves that every stock goes up 10%. All right, so now it's just a matter of timing the shorter term wiggles with the stocks. But again, if you're going for the bigger moves and you're more of a traditional O'Neill type investor, O'Neill would add to his positions from base to base and build big positions. And that's how he made his money. I made my money. I started off building big positions like that. But I found it was easier, and that I could do it more consistently and deliver big returns year after year if I also brought in that shorter term trading and trade around my positions.
Yeah. Yeah, and definitely Bill O'Neill, when he started, it was kind of what you were talking about from the 80s,
He had no choice.
Yeah, exactly. It just that's what it was, right? You weren't going to be doing swing trading because
but I can tell you this. But I could tell you this. I guarantee you this because I've met Bill many times, and of course, David Ryan was my right-hand man there for almost a decade. That doesn't mean that they're not out of those stocks in a second if they move. Don't
absolutely.
Yeah, I always tell people long-term investing doesn't mean long-term holding losses. You should be a long-term investor and a very short-term loser. I have no, like, I'm not against, people say, Mark's a short-term trader. He doesn't, he's against, holding stocks. No, I'm not. I'm against holding losses. If the stock's performing, great, stick with it. You might have a big winner. And as long as it's performing. But what you want to do is create asymmetric leverage. And that means that you cut off the bottom side and you expose yourself where you've got big upside.
Right.
And you're not going to do that by buying crappy stocks that are at 52-week lows and aren't performing. That's just hoping and wishing that things turn around in a company that may never turn around. But when it's right in front of you and they're delivering, this also goes back to the studies. Everything can go back to the factor model studies with O'Neill and going back to Love, who wrote Super Performance Stocks. The earnings are generally on the table. 70% of the time, earnings are already on the table before the stock makes a big move. So you don't have to guess. So once again, it's what's necessary. People are trying to guess and front run everything. You don't have to guess. 70% of the companies have earnings on the table already for several quarters. So you can wait. You can wait to get that confirmation. And then and some of the ones that don't are simply biotech companies that they don't have earnings. So that's something they're going to trade purely on the technicals, and like INSM, that's a stock that we recently bought, and we're up about, well, I think we actually got stopped out of it today. We backstopped it, but we're up about 30% on it. They just came out, had phase 3 trials that were great. The stock exploded. It was a classic sort of power. I call it a power play, high type flag. That's a typical name that will be a stock that may not have earnings, and that's that other portion of the curve of outside that 70%, let's say.
Well, when we come back, we're going to get some more stock ideas from Mark and find out what he's into, and also we're going to talk about some opportunities to get more information from Mark coming up. Stay tuned. We'll be right back. We're back on the Investing with IBD podcast. Justin Nielsen here, along with Arusha Pieris, and our special guest, Mark Minervini, author, founder of Minervini Private Access, and also a 2-time U.S. investing champion. I should have also mentioned, you did mention this, that you were featured in the Market Wizards book by Jack Schwager. So, a lot of great stuff. That was David Ryan was also featured in that. So a lot of great information that you put out there from your books. So Mark, go ahead and talk to us a little bit about this event that you've got coming up in November.
Okay. Yeah. So, we talked about also, you mentioned Market Wizards. Bill O'Neill was also in Market Wizards. He was in the first Market Wizards. David Ryan, that's who inspired me, to go into the U.S. Investing Championship. David Ryan won the U.S. Investing Championship 3 times in a row in the 1980s. And that's what got me to want to trade stocks and be a great stock trader. So the Master Trader Program, the U.S. Investing Championship, now in the last 6 or 7 years, almost everybody who's been the leader or the winner went through this program. Many of the names that either won it or the top performers that get the triple-digit returns have gone through the Master Trader Program or have been our Minervini Private Access clients, and so we're very proud of that. We think it's the greatest trading seminar in the world for stock traders, and Market Surge has been a sponsor of this event for, I don't know, better part of 7 or 8 years now. And David Ryan was my co-instructor for the same about 7 or 8 years, and now Mark Ritchie, who is one of my assistants at Minervini Private Access, he's my co-instructor. So this is coming up in November, and it's 5 days of curriculum. We have a couple of days of Q&A. It's a total about 7 days total, and all the stuff we're going over, we go over in nauseating detail for days and days and days and days, and really you learn everything A to Z of pretty much everything that I know and have learned in the 41 years of trading. But wait, there's more. If you do come to this, we also have, for our customers that are private access, or if you come to our events, we have a gala each year. And this is where everybody gets to come and we hang out and we discuss stocks and do tutorials and have special guests. And it's just a chance for everybody to meet. But this year is my 60th birthday on January 19th. And the 18th is our gala event. So if you do come to the Master Trader Program, you're also invited to my 60th birthday party, which is at the House of Blues in Myrtle Beach, South Carolina. We're having a live national act. I'm playing drums with the band. It's just going to be amazing and a lot of fun. So just want to invite everybody.
Yeah. Well, and Arush and I are going to be there as well because I mean, I wouldn't miss it. That sounds like a good time. So
there'll be a lot of people there from all over the world.
Yeah, very good. Well,
yeah, and actually, Justin, very quickly, because it's all online right now. But
yes,
back in the day before COVID and all that, it used to be in person. It was a 3-day event, and it was amazing. I mean, and it still is amazing online. But what I like about the gala and the birthday party is it's this really unique opportunity to go and really get together with a lot of other people who are really into investing and learning growth investing and really the way Mark does it. There's just so much energy there, and we were like in those classes, Mark, what, like 12 hours a day, and it's just nonstop, and Mark's standing on stage for that whole time.
I broke my foot. One day I stood so long that I cracked my foot. I actually broke my foot because I stood for almost 12 straight hours on stage. And yeah, it was crazy. I mean, I didn't know you could break your foot just by standing on it, but I did. And then we did it 2 more days with a broken foot. It was craziness. But what we found was 2 things. One, so people were after COVID, we went online and people were really upset that they couldn't have that live experience, meet each other, meet me. So now we sort of give the best of both worlds. The online, actually, I think you learn better on the online.
I agree.
You get more excitement and there's more visceral interaction. But online, I think you learn better. But now the gala event, you get to hang out. So we do both of them now. And the gala event is free. So if you're a client of ours, if you come to the Master Trader Program, you're welcome to come to the gala, and we do training there too. So it's a learning experience. Yeah. The gala's been even more exciting than the Master Trader Program.
Yeah, and there is something about kind of surrounding yourself by. I mean, these are not just beginning investors; these are top-notch traders that are a lot of times repeating your class because they just want to get those lessons really ingrained.
We've got people that have come every year for 8, 9, 10 years in a row. It's quite amazing. Usually those are the better performers too. They're that committed, and they're constantly learning. I'm constantly learning. We're all learning from each other. So yes, it's just you're going to meet some of the best people you'll ever meet in your life at this event.
Well, let's get back into stocks a little bit, and I'm going to start with a stock that you kind of mentioned at the end of the last segment. You mentioned that there were some pretty good clinical trials here, and this is INSM. I mean, this has had a big move, but can you kind of walk us through how you got into this exactly?
Yeah, so you can see that big explosion to the upside. That was when they had phase 3 results, and the stock responded very positively to those. Now, I won't generally just jump into a stock because it jumps on news. I like to see subsequent action, especially when you're in this case, this is what I call a power play. O'Neill would call it a high tide flag. The reason why is because once a stock goes up that much, if it doubles or triples, what really tells you the strength is that it doesn't correct much, that it can hold up. Now, you would think, a stock goes up 150%, let's just say a couple of days or a couple of weeks, there's going to be profit taking, right? And the stock just moves sideways and maybe only goes down 12, 13, 14%. That's telling you that there's no supply. Even after that big move, something is happening. Something really exciting is happening. So what we do is we wait for a consolidation, and as it comes out of that consolidation, that's where I would make my buy, and that's where we can see we made that buy coming out of that little sideways action, that first sideways action as it came out of there. And the stock was up for us. I think we were up about 30% on it over the last few days, or as of a couple of days ago. And we peeled out of some of it, and now we just I think we got knocked out of the remainder today. But I'd be looking to possibly re-enter on a reset on this. And again, this could be a stock that goes up much more.
Right.
I'm a swing trader, so a lot of times, I sell stocks all the time that go to infinity, and I buy stocks that go to zero. But I never hang around for either. So
Yeah.
Well, and it's interesting there when you look at this INSM. If you just look at just this chart, you wouldn't know that we've had this sell-off over the last few weeks, right?
Yeah.
Right. Well, so that's a good point, and this goes back to relative strength. And when you get stocks that have this type of alpha and this power of relative strength, these stocks are in their own cycle. They're in either their own earnings cycle or their own product cycle. Like, for instance, this is being driven by something that is much, much bigger than the general market. The general market's not affecting it. And so that's where you get those uncorrelated conditions. So you don't want, if your stocks are going up when the Dow goes up and down when the Dow goes down, you're correlated to the market and you're going to end up getting market returns. So this is another counterintuitive thing to think about, that you want stocks that are zigging when you zag and zagging when you zig. And that sounds like, okay, that's great. But it also works the other way. When the Dow goes up and your stocks aren't doing anything, that's when people go, oh, this doesn't work, and they abandon the strategy. No, that's precisely what it's supposed to be doing. And those are those uncorrelated returns. So we're looking for alpha. We're not looking for stocks that track the market. We're looking for stocks that are outperforming the market and delivering that alpha to the upside. Not volatility, alpha, which is upside. Volatility is back and forth.
Talk a little bit about when this stock, you got it around 60, maybe a little bit under that. It goes up to 70 and then pulls back almost all the way back down to 61.52. Is that something that you're going to hold through, or are you selling into strength? How are you kind of handling that?
So you're talking about the pullback down to 61.52?
Yeah.
Right.
Yeah. So, I mean, again, if you're playing it for a bigger move, here's, something that you have to realize. If you're playing for a bigger move, you've got to sacrifice the shorter term move. You're gonna have a stock that goes up 20%, and now it pulls back. And if you want to play it for a big move, you might have to let that come all the way back down to your break-even point, or even stop you out at a loss. There's no way around it. And if you're going to be a shorter term trader, okay, the stock runs up, I sell it into that first run. Maybe I'm up a nice 20% in a couple of weeks. I sell it, but now I give up the big move. There's no free lunch, right? So the way that I like to do it is, and in particular in something that's really powerful that could have the potential for a big move, I like to just de-risk my position. So I'll de-risk it in one of a couple ways. Stock goes up, and maybe it's 10, 20%. The more it's up, the better, because the less I have to sell to finance my risk. Let's just say I have an 8% stop. The stock goes up 8%. If I sell half the position, I can let it come all the way back down and stop me out, and I break even. Now, I only have a half position, but I have unlimited upside on a half position and zero downside. I'll take that any day over a bigger position with the risk of loss. I've eliminated the risk of loss at that point. Another way is, if you want to keep the whole position, you just move your stop up to break even. And I wouldn't do that too quickly, because if it just goes up 5%, and breaks out, it could easily pull back and stop you out. But a name like this, you're up 25, 30%. Now you can move your stop to break even and give it a lot of fluctuation, and maybe even sell a portion. So now let's just say you're up 30%. Well, now you only have to sell maybe 300 shares, and you can keep the majority, 70% of the position, and you're fully financed. Your risk is gone. You don't have any risk anymore. So we actually have a calculator that you put in the price, and you put in where it is in your stop, and it'll tell you how many shares to finance your risk. So you can just do that with an adding machine and just figure out exactly where you are currently and how much you need to sell to finance that risk. So I sort of take that middle of the road safe play a lot of times.
Yeah, perfect. Let's go ahead and talk a little bit. Semiconductors. I mean, look, it's everyone was talking about NVIDIA, and that was the big behemoth, but there are some other players out there. Let's talk about AOSL. This is Alpha and Omega in the semiconductor fabless group. This seems like another power play that really came out strongly.
Yeah, it's another one. This is one where you guys, I think on Market Surge, you have the ants indicator, right?
Yeah.
If you look right there, going into that little high where it peaked just a couple weeks back after it ran up, you'll see a couple of days where you should probably have ants. I'm not sure. We calculated.
You know, I think this indicator actually takes into volume and there's tons of volume. I'm not sure why it's not showing the answer, but yeah, but the answer will show up. But I think it was a little modified from the original answer version.
Okay, so we look for the 12 out of 15 days up. I mean, that's you know, if it says 12 out of 15 days up, that's pretty powerful. And when we take that into consideration, that it's also you know, doubled in a very short period of time. That's really strong momentum. That's got that alpha. And again, we want to buy those stocks once they consolidate and they start turning up, because those are really good risk reward plays. So this is one that, you know, we just, you know, bought recently. Actually, it pulled back just the other day, and as it started coming up from the pullback, we added to the position. So we're up on it now. So you'd be chasing it up, you know, above where I purchased it. I'm not sure. I think I'm up maybe 11 or 12% on it. I don't have it in front of me, but something like that maybe. So it is up a little bit from where I bought it, but still, this looks. And again, who knows? You know, maybe it'll get washed over a bit from the tech sell-off. But so far, it's holding up pretty well.
Yeah. And then let's wrap it up with one that a lot of our listeners are going to be familiar with, ON Holdings. ON is the ticker symbol here. I mean, this, you know, this was a big mover a while ago. It kind of, you know, came back. It's below its 50-day moving average line. What's looking interesting here to you?
So it'll be interesting to me if it can hold up, particularly if the market corrects more here, and this just stays tight here and builds this right side. We could get a nice, what I call a cheat area, which is a lower pivot within the base, usually in the lower to mid 1/3 of the base, as opposed to being in the upper 1/3 where you would have the traditional, you know, O'Neill handle. So I'm looking for this to tighten up and give me an actionable buy point. It's not there just yet. You can see it's jockeying around there. There's some reversals, so there's some supply definitely there. So I don't think it's ready just yet. But this is one of those companies that I think could be a potential takeover, or a company that could get bought. Something like we talked about this, where, you know, Nike and somebody who, you know, one of these shoe companies maybe that is not doing so well wants to, you know, bring on a brand that they can expand and add to growth. That's you know, this would be much more growth oriented. So yeah, again, that's you know, that's not something that I would hang my hat on and trade a stock on, because I think it's a takeover candidate. But this is one that I love the product, which usually is a kiss of death. Yeah, because I hate Kava. You know, I went to Kava and I didn't like it. And some companies that I loved went out of business. I always say I'm the anti-average guy. Like, when I like something, it usually doesn't do well, and when I love something, you know, it doesn't hit the mass markets. But I think everybody can agree that, you know, the OnCloud shoes are a superior sneaker, and they've done a really good job, I think, with the brand. So, but it's going to have to set up. Like I said, never buy the story, never buy the numbers unless the price confirms. So this is in the earlier stages. It's a recent IPO not too long ago. And now we're going to need it. Yeah, you see there where you've got a recent IPO, and now you're going through that big basing process, and that right side. This is similar to LinkedIn. LinkedIn came public. Even Facebook came public and then corrected, and then it took a number of, you know, months, even years, before you got that right side. Yeah, what are we looking at there?
Well, this is a monthly chart of Facebook or Meta, right? It was back here.
Yeah, so Facebook, you can see, then it correct. I remember Facebook was sort of like what I was talking about with AI, where it's so inflated prior to it coming public that it almost is guaranteed to fail. That's what happened with Facebook. But if you look at Facebook and you look at the earnings and sales in that first few 6 months or so, their earnings were not good, and their sales, and then they started to come in with the numbers, and that big move there, that big weekly move, was on an earnings report that lit the stock up. And then from that point on, they had really strong earnings. They were coming out with triple-digit earnings reports. But you could see it wasn't it wasn't a stock that was buyable right off the IPO. It took some time. LinkedIn is no longer. I don't think you can pull up a chart from that.
But Mark, going off with Facebook and that jump in July, I think it was July in 2013. Going back to, like, you don't have to buy the bottom. On that gap up day, Facebook was up 29% on that gap, and the volume was 700% above average. So you don't,
and that was the start of the move.
Yeah, that was
really.
the start of the move, right? Yeah, yeah. You assume that was the the end of it. You were really wrong.
And kind of like what we were talking about with the AI, what really came out from that earnings report was, oh, we can monetize our subscribers. Everyone knew that they had a lot of subscribers, but that was kind of like the proof, like we can make money off of these guys.
Yeah, but not much else existed. Like, it wasn't like now where social media and all these companies, everybody's got the model already. Facebook at that time, there was very little competition and anybody doing what they were doing. Now, so I'm just curious,
right?
Hey, I'm curious, that correction from the peak of where IPO down to that low, how big is that?
It was from 45 down. It was around 50%. Oh, you might more than 50%. 45 down to 17. That's
almost close to 60%.
Yeah. Okay, so there's my exact example I said before. So let's just say you bought the exact low in the bottom of that correction.
Yep.
Okay, so to get back up to old highs, you would have been up 100%.
You're right.
But that's only that's the very beginning.
Yep.
The real money is after that. The money is in new high ground. The money is after the relative strength is a 99, is a 98. The money is later in the uptrend. It's not buying the low. Even if you peg the low before, and I'm buying a new high, I'm buying it at all-time highs. You're buying it at all-time lows. You pick it dead on. I buy it at the highest price it's ever, and we both hold. Yeah, okay, you're ahead of me if you hold from there. But if you sell it, and I mean, if you were thinking I'm not going to buy at a new high, you're probably a value guy. You're probably selling it when it gets overvalued, right? Yeah. I'm buying it when it's overvalued, but I've got the runway.
And you also got to think of those folks that are trying to do that system, that consistency part. How often can you get that low? How many of them just keep on going lower? And that's where people can really get into some trouble, when the low isn't the low.
Yeah, I don't have to pick the dead low. I don't have to pick the low in my system.
Yeah. Well, hey, Mark, it's always a pleasure having you on the show. That's it. Yeah, exactly.
We're all done?
Yeah,
we're all done.
Mike won't let us go longer.
I thought.
Well,
don't get us started. We could do another hour with you if you want, but we'll save some for your masterclass. And again, if folks haven't read your books, really, Trade Like a Stock Market Wizard is a classic. Think and Trade Like a Champion, a classic. Mindset Secrets for Winning, a classic. I mean, you just have some really great books. You got the masterclass coming up, the gala in January, the 60th birthday bash, a lot of great stuff.
A lot happened. And
a lot happened in this year.
Another book. I'm finishing up another book now, which is going to be a great, it's going to be a really great book because it's boiling down everything to my rules. It's going to be all the rules, all the concrete rules and explained. It's going to be a really good companion to the other books. And I'm trying to finish that up too. So I got a lot going on by the end of the year.
I'm gonna put some room on my bookshelf for that once it comes out. So
I'm working as fast as I can.
Okay. Well, hey, Mark, great having you on. It's always such a great learning experience for us, for our subscribers, and thank you so much for taking the time.
It's been fun. Always is.
That's going to wrap it up for us on this show. Don't forget to tune in next week. We're going to have Jason Shapiro back on the show. So it's like we had David Ryan, a market wizard, Mark Minervini, a market wizard. We've got another market wizard next week. Jason Shapiro, he, of course, is the founder of the Crowded Market Report. Lots of great stuff in terms of the contrarian view on things. So it's going to be great to chat with him a little bit, especially right now, to get his contrarian view on things. So we hope you join us for that. Thank you so much for watching us this week. Don't forget, you can always get the full video at investors.com/podcast. And you can certainly get access to the podcast at any of the podcast areas that you are using, whether it's Spotify, Apple, what have you. And don't forget to like and subscribe. It really helps us out. Thanks a lot for watching. We'll see you next time.